SP Gad has this question. He says, I'm 35 years old. I have a lump sum investment amount of 30 lakh rupees, which I want to put in mutual funds for 5 years. How should I go about investing?
Mr. SP Gad, you have been saying that I have a 5-year horizon. So when we talk about investments in mutual funds, we always say when you look at equity as an asset class, please look at little longer period. Look at 5 to 7 years as your investment period, because markets are not cheap even now after the little bit of correction over the last.
35 years old.
And he's pretty young.
15, 20 years,
but in case he needs money, we don't know this. He's not defined that very clear. If he needs money in 5 years from now, while equity is a good asset class to look at, but it may be a scenario that you may end up need to hold the money for a little longer duration beyond the 5-year period you are asking for. So therefore, if you think you cannot hold the money beyond 5 years, while age says you should hold the money, but if you think you have need coming in the 5th year from now, then you have to create a balanced portfolio for yourself. You cannot go full throttle in equity. So create a balanced mix. In a balanced portfolio, you can buy a debt fund, which is an accrual strategy for a 3-year period. You can even buy a balanced fund, which typically is 70% debt, mandate is 65%, but typically they hold 70% equity. You can even buy a multi-cap strategy. So maybe you can have a 3-fund portfolio, one on the debt side, one on the balance fund, and one on the pure equity, which is the multi-cap strategy. So these three funds will help you in good stead. And as you come close to the 5th year, if that's the period I assume you need the money, the balance fund and the equity fund, you need to withdraw that money and move to debt as you come closer to the maturity, the period you want the money to be used for. Because you never know that the money when you want to consume, markets may not be in a good health. So it's good to protect yourself, and as you start the 5th year, start withdrawing. But in case you think you can hold the money for 7, 8 as we put for even a longer period, then you should go equity in the complete portfolio, because then you don't need the money in the short term. So understand what you really want to do, but yes, equity is a way, and because you have a lump sum money sitting with you, do a staggered purchase as far as equity investments are concerned. Don't put money on one single day in lump sum. Do a staggered purchase by putting the money first into a debt fund and then transferring.
What is a staggered purchase?
So that's called an STP, systematic transfer plan, where you first put your money into a debt ultra short term fund, which is a liquid fund also, and which earns you something like a bank fixed deposit kind of interest rate, but doesn't have any exit loads. So you put your lump sum, let's say he wants to put in some X amount of money, so out of that 5 lakhs he wants to put into a debt ultra short term, from where every week or every fortnight or every month, you can stagger your purchase into the respective fund which you eventually want to go to for the equity investment. Okay. So this helps you to contain a little bit of volatility which is there in the markets.
Just also like what an SIP does.
Absolutely.
Except that you put your money in a debt fund, it goes every month like an SIP.
Of course.
SIP people understand.
So it's something like an SIP model, but where you have a lump sum money and not money coming from the bank.
So rather than the money sitting in your bank, you put it in a debt mutual fund.
And it's earning you a bank FD kind of
return than a savings account money lying.
It helps you to also do a rupee cost averaging, contains that volatility, and just installs a little bit of more discipline in you, Vivek. That really helps the matter.